Now, let us start with our next topic, that is multi-factor models part 2. In this particular model, we are taking into consideration three components, that is consumption based asset pricing model, Cahart 4-factor model and Fama-French 5-factor model. So, these models has been developed in different time period, but the base model is CAPM model. So, in the previous lecture, that is in lecture 2, we have talked about Fama-French 3-factor model. Here we are going to talk about Fama-French 5-factor model and Cahart 4-factor model. And one additional model, that is consumption based asset pricing model, that is based upon or is an extension of CAPM model. So, first start with consumption based asset pricing model. So, this consumption based asset pricing model is developed by Robert Lucas in 1978 and Douglas Braden in 1979. So, two of them clubbed together and developed this particular model. First, it is initiated with Robert Lucas and later it is finalized by Braden. So, consumption based asset pricing model is a fundamental theory in financial economics that links asset prices to individual consumption choices. So, when we talking about individual investors, we are basically concerned about how the stock returns or what is the expected return of a particular stock. Here in this particular model, they relate it with the economic concept, that is individual consumption choices. The foundation of these concepts are already laid by these two economists, and they basically forced that there are certain concepts in financial economics that are also very important, and with this we can say there is an extension of finance domain from normal finance, where we are talking about the asset prices or simply the stock market factors or market factors. Here we are also taking into consideration the utility based factors. So, it is an extension of CAPM model that I already mentioned. It incorporates intertemporal consumption decisions, suggesting that investors derive utility from future consumption rather than simply from financial returns. In the previous model, that is CAPM model, we are focusing on only stock returns. Here we are focusing on what is the impact of that on the future consumption requirement of the investor. The key concepts that are taken into consideration in this particular model are utility and consumption, that utility function. We already know in CAPM, utility is derived from consumption rather than wealth. So, how much particular thing is providing us a utility, we need to focus on that particular thing rather than generating wealth. Previous CAPM model is focusing on generating wealth, but here we are focusing on deriving the utility from the consumption. Investors aim to maximize their expected utility from consumption over a period of time, which incorporates both current and future consumption. In our definition also, we have tried to explain this concept. If you remember the first chapter where we talk about the definition of investment, we talk about two consumption needs, that is current consumption and future consumption needs. So, this particular utility function is a major focus of researchers, that they said that utility is more important than just focusing on the wealth. Intertemporal choices, the model emphasizes that choices individuals make about consumption over different period of time. Suppose this year I have different consumption need, 2024 I have different consumption need, 2026 I required a refrigerator, in 2030 I need a house. So, these are my different consumption needs. So, we need to focus on this rather than focusing on just on the wealth of a particular investor. So, considering how current consumption affect future consumption possibilities. This year, suppose whatever savings I have utilized in purchase going for a tour. In that case, I do not have enough money for next year, so I cannot go for purchasing a refrigerator. Then we have to take into consideration 2025, I have to save, and then I can purchase a big refrigerator, suppose costing 1 lakh rupees. Okay. Similarly, I have to purchase a particular house, I need to save for 4 years from 2026 onwards to 2029, so that I must have a margin money with me, I can pay the down payment and purchase the house. So, these are certain things which we need to consider while investing also. So, when we are talking about these particular consumption patterns, we are focusing on current consumption, and on the basis of that current consumption, what will be my future consumption that may get affected by the current consumption requirement. So, researchers basically try to focus on this, because we are focusing on financial economics, they take into consideration the utility concept. Now, risk aversion coefficient, the model incorporates a parameter that measures an individual's risk aversion, indicating how much utility decreases with potential loss of wealth. So, if there are chances that I am going to lose the money, automatically I am not going to utilize that particular thing, or I am not going to invest in that particular thing. So, if we find that there is chances of loss, my utility will automatically decreases from that particular consumption. Suppose I think that purchasing ABC stock is going to give me losses in future, in that case my utility from that stock will automatically decreases. I will try to invest in other stock which is having a better potential of giving return. Higher risk aversion implies a stronger preference for certain consumption over uncertain future consumption. So, everything in this model, if we look into this, are based upon consumption requirement of the investor. If we see that there is higher risk aversion, automatically we are focusing on certain things that are going to give me certain types of benefits or certain utility, but we are also focusing on uncertain things that are decreases my chances of utility, and I am not focusing on that. So, whatever my preference is towards certain consumption requirement rather than uncertain consumption requirements, because they have larger chances of losing wealth. Discount factors, investors have a preference for current consumption over future consumption, which is represented by a discount factor, that is time value. These factors reflects how much future utility is discounted when making current consumption decisions. So, this particular model is based upon certain economic factors taken into consideration, like consumption or utility, how much utility I am deriving from a particular consumption. So, whether it is certain or whether it is uncertain, if the chances of certainty is more, I am focusing on that. If the chances of uncertainty is more, I am not focusing on that particular thing, because the chances of losing money or wealth in that particular case is higher. Now, what are the major advantages? Macroeconomic foundations. First, the basic foundation is CAPM model. In CAPM model, we are focusing only on risk, but in this CAPM model, it is taken into consideration microeconomic variable, that is utility. Then there are temporal choices into consideration, because we are focusing on different choices that has been made by an individual at different period of time. Realistic representation, the model offers more realistic representation of how investors make decision based on consumption rather than returns. In CAPM, we are focusing on returns, here we are focusing on consumption. Applicability, CAPM can be used to analyze pricing of various assets, including various instruments like stocks, bond, derivatives, by linking them to the consumption pattern of the investor. So, according to my consumption pattern, my requirement for wealth will change. Automatically, if the consumption is certain, then I will focus that my utility is high, then I am going to invest in that. If the utility is uncertain, or we can say the consumption pattern is uncertain, and I know that there are chances of losing the wealth, in that case the utility from that particular consumption is going to be 0 or less. Now, what are the limitations? First is data requirements. So, we require detailed data of consumption pattern that is difficult to obtain. Second, complexity in estimation. Again, discounting factor is a very important consideration, that is econometric consideration, and that is easily not calculated by the investor. So, in that case we cannot go for this particular model. Assumption on preferences, the model relies on specific assumption about utility function and consumer preferences that may not hold in reality. For example, constant relative risk aversion may not accurately represent actual investment behavior or the actual investment pattern of the investor. So, in that case we cannot say that the investor is focusing on utility of wealth only. Market efficiency, CCAM model assumes that markets are efficient and that investors act rationally, which may not always the case due to behavioral biases. So, there are certain biases, or we can say the certain limitation of this particular model. So, in CCAPM model, we focused on the consumption pattern of the particular individual investor. Now, coming to the next model, that is Cahart 4-factor model. Cahart 4-factor model is basically an extension of Fama-French 3-factor model. So, this model has been propounded by Mark Cahart in 1997. It incorporates an additional factor, that is momentum, along with the value and size premium factors. This model aims to provide more comprehensive understanding of the drivers behind asset prices and returns. So, what are the key components? First component is market risk, that we already talked in Fama-French 3-factor model. Similar to CAPM Fama-French model, this factor reflects the excess return of market over risk-free rate of return. It captures the systematic risk associated with market movements. Second one is size factor, that is small minus big, SMB. This factor represents the return difference between small cap and large cap. Then there is a value factor, that is HML, high minus low. So, this factor captures the value premium reflecting the return difference between high book to market ratio stocks and low book to market stocks. These are already elaborated in Fama-French 3-factor model. The next important factor that has been incorporated in this model is momentum, that is represented by MOM. This factor reflects the tendency for stocks that have performed well in the past to continue performing well in near future. So, what we are considering, if we have a group of stocks along with us, we need to identify which particular stock perform well in, suppose we are taking a data of 5 years. So, we need to consider which particular stocks performed well in last 5 years, and on the basis of that we are going to consider this. Conversely, stocks that have performed poorly tend to continue in the underperforming. So, there are two categories, high performing stocks and low performing stocks. Calculation of momentum, the momentum factors is typically constructed by taking the average return of top performing stock over a specified period of time, suppose 5 years, and subtracting the average return of worst performing stock. So, what we have to do, suppose we have a particular list of stocks, we need to calculate the average return first. I have already told you how to calculate the average return. Then on the basis of this, we have to arrange the array. Suppose we have 1, 2, 3, 4, 5, 6, 7 stock with us. Now, what we are going to do, we have to arrange it according to their performance. So, suppose 3, 2, 5, 2, 4, 5, 6 has performed well, 7, 1, 3 hasn't performed well. So, we have this particular category of stock with us. These particular stock perform well, we can say high performer or top performer, these are low performers, and we have to deduct it, the average return of these particular stock, and on the basis of that we can calculate the momentum. So, this is the basic formula of Cahart 4-factor model. RI, that is stock return, RF is a risk-free rate of return, BI is the sensitivity of market, that is RM minus RF, SI we know the sensitivity of small minus big firm, HI is the sensitivity of high minus low firm, MI is the sensitivity of momentum and error term. So, this is the basic formula. In Fama-French 3-factor model, we have incorporated these taken into consideration these 3 factors. In this Cahart 4-factor model, momentum has been added and it has empirically tested to prove that this model can be used in real life situations also. Now, what are the advantages? It is providing us more explanatory power. In Fama-French also we are able to understand, because of incorporating 2 factors we are able to understand the stock return much better way. When we incorporated the another factor, that is momentum, we are able to explain it in a much broader way, and it is going to give a better explanation of the market anomalies. Practical application: investor can use this model to construct factor based investment strategies that take advantage of the identified size, value and momentum premiums. Then performance benchmarking: we can easily go for evaluating the mutual funds or different types of index fund on the basis of this and identify whether the particular fund manager is performing well or taking into consideration the different anomalies that are prevalent in the market, and on the basis of that they are constructing the portfolio or not. There are certain limitations associated with this particular model. The first one is assumption of stability. Like multi-factor models, it assumes that the relationship between the factors and returns will stay stable, but in reality the market dynamics changes and the factor prices or factor premiums may affect each other. Complexity: the addition of momentum increases the complexity of the model and it requires sophisticated data analysis and data. This complexity can be barrier for some investors also. Potential overlifting: as more factors are added, there is a risk of lifting the model to historical data, which may limit its predictive power, similarly to the Fama-French 3-factor model, where we consider only the historical data, and on the basis of historical data we cannot predict the future accurately. Same in case of Kahat 4-factor model, we are taking into consideration the historical data, and on the basis of historical data we calculated the return. So, we cannot 100% predict the future on the basis of this. Generalizability: while the model has been validated in various markets, whether developed, underdeveloped market, it is applicable across different economic conditions and markets may vary. The effectiveness of the momentum strategy can be influenced by the market cycle, and in that type of situation this particular model may prove faulty. So, we need to consider that these models, although they are tested and back testing has been done, still there are some discrepancies associated with this model. We cannot accurately use this model in a particular market conditions like India or any suppose Japan, that is a developed market. So, different markets have their own characteristics and that might affect the particular return pattern of the model. Now, coming to the next model, that is Fama-French 5-factor model. The model is an extension, already by name we can understand that this is an extension of Fama-French 3-factor model, and when Kahat has developed his model, we can say that this model is taking into consideration other factors also. So, it is developed by Fama and French in 2015. Then what are the components similar to that particular previous model, or we can say the Fama-French 3-factor model, the base component is market risk. We already know about market risk is the difference between market return and risk premium. Size premium, that is it is the difference between small cap firms and large cap firms. Value premium, that is the difference between high book to market value ratio to firms with a low book to market value ratio, that means value firms and growth firms. Next two factors that is taken into consideration by Fama-French is profitability, that means robust minus weak. This factor captures the difference in returns between companies with high profitability, that means robust, they have the robust performance or they have the they are continuously providing high profitability or higher returns to the investor, and those with low profitability, that means weak firms. So, low firm versus weak firms. So, profitability, in this profitability we focused upon robust minus weak, that means companies that are providing high profitability and companies that are providing low profitability. So, we need to consider or capture the returns of the companies who are having high profitability and low profitability. So, research indicate that more profitable firms tend to deliver higher returns. This factor addresses one of the limitation of previous model by considering the operational efficiencies of the company. In last two models, we are basically concerned about factors that are important from the point of view of market, but here we are looking into the company related factor also. So, Fama-French incorporated a company related factor, that is profitability, into the model. The second one is investment, conservative minus aggressive investment. This factor reflects the difference in returns between firms that invest conservatively and those firms that invest aggressively in the market. It captures the tendency for the firms that invest less to outperform those that invest more. So, this factor addresses the risk associated with aggressive investment strategies, suggesting that companies with more prudent investment policies tend to provide higher returns. So, again this is a firm specific factor, where we are considering that if a company invests their funds in market or any other particular project, what type of decision they are taking, whether they are conservative in decision taking or they are aggressive in decision taking. If they are more conservative, in that case returns will be low. If they are aggressive, in that case returns will be high. So, this is the model. Same model has been used, but two components that has been added, that is PI into robust minus weak and CI into CMA, that is conservative versus aggressive. Now, coming to empirical evidences of this particular model. First, the 5-factor model has been empirically validated through extensive research by researchers of different countries, whether they are from developed market or from emerging market. Everyone has tried to incorporate this model in their research and evaluated it, and it somehow find that this particular model is quite significant or robust in the context of developed market. Studies indicate that model explains a larger portion of stock return variations compared to 3-factor model, because this particular model is taking into consideration other 2 factors that is already available in 3-factor models. So, this particular model is more robust in explaining the risk factors. Now, coming to advantages of 5-factor model. The first one is comprehensive framework. By incorporating profitability and investment factors, the 5-factor model provides more nuanced understanding of asset returns compared to 3-factor model. Because in 3-factor model, we are only considering in the market related factors, like we have taken into consideration the SMB or HML. But in this particular model, we are also considering the firm specific factors like profitability and investment. With the help of profitability, we are focusing on which firms are continuously paying higher returns or having a higher profitability, and which firms are having lower profitability. And in case of investment factors, we are considering which firms are having conservative investment strategies and which firms having aggressive investment strategies. So, there are certain factors that are more prominent and specific to firms. So, this is a more comprehensive framework with which investors can easily evaluate a particular portfolio. Practical application: the model can be used to construct factor based investment strategies, enabling investors to capitalize on identified premiums. So, there are 5 premiums. In previous model there are only 3 premiums available, but with the help of this particular model we can go for further premiums. Performance benchmarking: it serves as a benchmark for evaluating mutual fund performance, allowing investors to assess whether fund managers are delivering alpha after accounting for these factors or not. So, alpha is a basic factors that where investors are considering in, I think in CAPM model you have gone through the concept of alpha and beta properly, and we as investors are mainly focusing on capturing that alpha, because beta we cannot go for, it is a sensitivity to the market and we cannot go for that particular thing. So, what we are focusing on? Calculating the alpha. Then what are the basic limitations? The assumption of stability. Like other multi-factor model, it assumes that relationship between factors and returns are stable over a period of time, which may not hold in all market conditions. So, depending upon the market cycles, depending upon the market situation, these particular models may vary and give varied results. Complexity: this particular model requires sophisticated tools to analyze it. So, if the particular investor do not know about the sophisticated tools, it becomes very difficult for him to understand or calculate this particular models. Potential overfitting: With more factors, there is risk of overfitting the model to historical data, which may limit its predictive power to future performance, because on the basis of historical data we cannot predict the future 100%. So, it may become difficult for the investors that if they take into consideration this particular model, their results may vary in future too. Generalizability: while the model is robust, its application across different markets and economic conditions may vary depending upon the market scenario. So, with this we come to end of this particular topic, that is asset pricing models part 2, and we have covered various models under this particular module. Thank you.